How to buy a small business. Startup, buying existing, buying a franchise. Startups sometimes work very well, especially if you have a product and or service that is new and different and the marketplace accepts your new business. Buying existing. The same statistics that apply to the failure rate of small businesses show that if you buy any existing successful business, it already has trained employees, an existing customer base, existing sales, and established cash flow, sufficient to pay the business expenses and provide the owner with a living. Buying a franchise. The 90% plus success rate applies to buying a successful franchise, provided that the franchise has already proven the market's acceptance of that franchise concept. Successful business people all have the following traits. Number 1, they made decisions quickly and easily. Number 2, they like what they're doing. And number 3, they own their own businesses. In order to make the best decisions, we need to start by gathering as many facts as we need. Search for as much good information as available and consider as many options and possibilities as necessary. Study them and select them the best options for you. As you make decisions, making decision becomes easier. The existing business owner or franchisor who knows more about the business or franchise than anyone else in the world will have vested financial interest in your success, and they will help you to learn how to understand, manage, and operate the business successfully. The most important advantage of buying an existing business is that you get an immediate income. This income should provide enough income to pay the business's expenses, debt service on the acquisition, and give you and your family an immediate income. If an owner is selling a business, it is the seller's discretionary earnings, SDE, that helps define value. Most businesses are valued and sold based on some acceptable multiple of SDE. If you buy the business and run it in a similar way, you should expect to have some same SDE. Business size makes a difference. The size of the business that you are looking at can make a difference in several ways. Some obvious, some not. They operate under different rules depending on their size. Big business rules. These rules may apply to any privately owned business that does $30 million in gross sales or more, owned by shareholders, managed by CEOs, COOs, and CFOs, and others. They have the same audited financial statements and report them to the public on a quarterly and annual basis. Audit has to be done by a qualified certified public accountant or an accounting firm. Number 2, small business rules. Small business rules apply to any privately owned business that does between $1 million and $30 million in gross sales. They usually have hired management in addition to the owner, and they normally deal with audited financial statements. They most likely have reviewed statements, and the owner may also be the manager. The owner probably has a bookkeeper or a bookkeeping section in addition to him or herself. 3. Small business rules. These rules apply to any privately owned business that does less than $1 million in gross sales. The owner usually also is the day-to-day manager, the head salesperson, the PR person, the stock person, the bookkeeper, the janitor, and the person in charge of the checkbook. The owner hires, trains, manages, and fires employees, and he or she is responsible only to him or herself, and almost never has an audited or even a reviewed financial statement. The owner deals with the compiled statement of filing taxes. Number 4, real estate rules. Real estate is one of the most public businesses in the world, with a big for sale signs that placed on the property that advertises its price. All real estate transactions are recorded. Mortgage owners will normally lend up to 90% of the value of an owner-occupied house base on comparable sales. Almost all real estate brokers co-broker a sale. Sales drives value. If there are low sales, that business entity has low value. Sales are market's response to a business's or product service. Therefore, gross sales help define the value of a business because the real bottom line of earnings has to come out of the top of the line of gross sales. The potential earnings of the owner of a business worth is less than $1 million, or around 10 and 20% of a business's gross sales. Then, when a business is worth more than $1 million, the owner earns 10% or less of the business gross sales. This is because the larger the business, the more management and inventory costs. Value drivers of a business. To value a business, it is important to consider the following. Number 1, the location of the business. 2. Furniture, fixtures, and equipment that help produce the company's product or service. The inventory or product that the consumers buy from the business. Number 4. The trained employees of the business. 5. Existing customer base that buys the company's product and services. 6. The established cash flow sufficient to pay all of the business expenses and provide for the owner's lifestyle. 7. The business's financial records. 8. The industry itself, does it have a shelf life? 9. The established vendors-suppliers relationship. Number 10. Competition. 11. The possibility of seller's financing. Number 12. What you, the buyer, are going to do with the business after the sale. When buying a business, one of the first questions that comes to mind are how much money can I make out of this? To determine an estimate of this number, you have to consider the following issues. Number 1. How much is the present owner making? 2. Less any debt service or other costs that you would have in buying the business. Number 3. What would you do to improve and grow the top line and bottom line? How do you find the right business? When you are selling a house, you want the for sale sign on the property. Advertise the land in as many sites as you can and make it as public as you can. Unlike selling a business, you don't want anyone to know. Not the business employees, not their customers, not their competitors, not the vendors, not the landlord, or the banks. This should be a confidential sale. If you want to buy a business, make sure you do the following. Number 1, contact a local business broker. Number 2, check the local newspaper classifieds, business opportunities / business for sales. 3, approach business owners or business you like, see if they want to sell or if they can refer to you someone that wants to sell. Focus is important. As you find businesses that you would consider buying, you should request as much information on each business as you can and narrow down the options. Discard the ones you like the least until you find the option you like the most. When contacting a business broker to request information for a business, don't be surprised if the broker doesn't share much information by email or the phone. They do this because one of the following reasons. 1. Confidentiality. You could be an employee of that business or a competitor, just trying to get information on the business and find out if the business is for sale. 2. The broker knows that 90% of the time a prospective buyer will not buy the business that they called in on. 3. Brokers know that 90% of the time buyers do not know what kind of businesses they want or best serve their needs or how to buy them. 4. The broker knows that he or she cannot really help you without taking the time to get to know you, to know your needs and capabilities, whereas broker can possibly help you if he or she gets to know you and vice versa. Business brokers almost always work as agents for sellers, primarily because they get paid a percentage of business sales. This does not mean that they are against the buyer. This is because without the buyer to buy the business, the seller cannot sell the business, which means that the broker is not paid. Just as you would not get married without going out on a first date, then building a relationship, you should most certainly not buy a business without personally getting to know everyone with you are dealing with, and then building a mutually beneficial relationship. Focus is important. Number 1, focus on the business, not just on the financial information. If you do not like the business, the numbers do not matter. The most important thing is that you find a business that you like and you feel you can manage and grow. 2, focus on the top line, growth sales, not the bottom line of the business financials. Remember that the financials have been done by the business owner's accountant with the primary goal of minimizing taxes. That is what you pay your accountant for, to legally do everything he or she possibly can to minimize the taxes that you have to pay. Do not be surprised if the financials show a loss for tax purposes. 3, focus on what you would do with the business after the sale and not just on what the present owner, seller is doing or has done, the most important to you. Management plays such an important part in a business's success or failure that it is recommended that you ascribe a weighting to your own decision as follows. 30% of the weight of your decision to buy a business should be based on what and how the present owner has run the business for the last few years. Think about it. What can you change about how the seller has run the business for the last 15 years? You cannot change a single thing about the past. What you can change is what you would do if you own the business. 70% of the weight of your decision to buy a business should be based on what you would do after you own the business. What one, two, three, or four things would you do or change to improve and grow the business? While you cannot change the past, you can most certainly change the future. Every business can be improved. When you buy a business, you buy the business because the value of the potential earnings that you see going forward. However, you pay the seller for the value of the business today based on the present earnings. How much can I make? The three most important inputs to value in a small business are: number one, location, depending on the type of business. 2, the track record of the business, including the trend of sales. 3, the management of the business. To answer the question, how much can I make, starts with, number one, how much is the seller making now? 2, less the debt service created by the acquisition. 3, the buyer is going to do, operate, improve, and grow the business going forward. Financing, the key to success when buying and selling. To acquire or start up a business for two reasons that actually have very little to do with you and your credit. Security. The bank has to have a security for the loan. Security meaning, in the worst case scenario, what assets could the bank seize, take back to marketplace, and get their own money back in 60, 90 days. And the assets of a closed business have little, if any, value in the marketplace. 2, proven debt repayment ability. The bank has to see where the debt repayment is coming from. And since you are depending on the business's future earnings to provide for the repayment plus give you enough income for your personal expenses, the financials of the business have to show the available cash flow to accomplish that. They seldom do, since most often the focus of the formal financial records is to minimize taxes. Many businesses actually show a loss for tax purposes, and the bank would like to have at least 125% cash flow to loan payment coverage. If you do not want to deal with bank loans, there's another option: seller financing. Seller financing is a real estate agreement in which the seller handles the mortgage process instead of a financial institution. It makes so much sense for both seller and buyer. The number one reason is that it helps sell the business for a fair price, but it also gives the buyer a level of comfort that the seller, who knows more about the business than anyone else in the world, is willing to invest in the go-forward success of the business. In order to buy a business, there has to be a down payment, and this has to be an amount of cash that you could put down on the business at closing and still have a little working capital available no matter what the seller is asking. As you are in negotiations to buy a business, make sure all equipment is to be in good working order and all licenses in place. The seller keeps the cash in the business and the account receivable and accounts payable. Buyers should always keep the following in mind. Take the time to look at the business market in your community and pay attention to the businesses that interest you and that you feel that you could run, that you would be pleased to say you owned. 2, make the time to visit personally with a business broker that has businesses listed in your market. This is far too important for just internet or telephone contact. 3, take the time to look and visit incognito any business opportunities that you are interested in. Get a feel for the business without anyone, including the owner, knowing that you are a potential buyer. Always meet personally with the seller, perhaps after hours, and with spouses, to get to know the seller, to hear the seller's story, including why is he selling and how much he thinks that you can be owning the business. It is also the best opportunity to make good first impressions on the seller, who you want to like you. Never do any face-to-face negotiating with the seller on the first business visit. You already know if you like the business, and you should have the preliminary financial information available to you as furnished by the seller, perhaps through the broker that represents the gross sales, what the seller represents that he is making SDE. Never start off with a full price offer. Never leave yourself without cash for your down payment. You have to have some working capital plus house payments, car payments, etc. All offers should be in writing with a requested response from the seller of from 3 days to a week. Due diligence. When you are close to finalizing a business deal, there's very important due diligence to verify information provided by the seller. Forming a team for this new challenge, including the buyer, seller, accountant, and attorney, helps the business stay in place. Due diligence process involves reviewing financial records, leases, contracts, and franchise agreements. Conducting an SWOT analysis, strengths, weaknesses, opportunities, and threats is a good asset to the business's opportunity and personal readiness. Ultimately, the goal is to ensure that the buyer makes an informed decision before proceeding with the purchase. Closing the purchase and taking over ownership. When the deal is closed, you have to have necessary preparations for the closing, including drafting closing documents, security finances, transferring leases, forming business entities, and conducting inventory checks. When the business is officially yours, try to maintain a positive relationship with the buyer and the seller. As well as with employees, vendors, and customers, closing a business isn't easy. This is why we advertise for the successful closing, scheduling early in the day, ensuring all parties are present, and fostering open communication with employees.